Hey everyone, and welcome to this explainer. Today we're diving into a genuinely fascinating story of corporate resilience right in the heart of the semiconductor industry. We're going to unpack onsemi's completely dynamic financial trajectory over these last couple of turbulent years. Look, the semiconductor market is notoriously wild, right? It's driven by shifting global demands, absolutely massive capital expenditures, and intense competition. But onsemi, they decided to tackle a major industry downturn with a highly specific, calculated strategy. Instead of just chasing pure scale, they chased discipline. We're going to look at exactly how they pulled this off and, crucially, evaluate their financial performance right alongside their biggest competitors.
Okay, let's dive into this beautifully structured briefing. First, we'll look at navigating the 2025 industry downturn. Second, we'll put onsemi head-to-head against the competition. Third, we'll break down their fab-right strategy. Fourth, we'll check out their swift recovery in Q1 2026. And finally, we'll look at how they're powering the future.
All right, Section 1, Navigating the Industry Downturn, the 2025 Trough.
So, to really get why onsemi is sitting where they are today, we have to zoom way out. We need to look at the intense macro pressures that basically squeeze the whole semiconductor landscape. Coming out of the pandemic, the industry got hit by rising geopolitical tensions, tariff wars, and a really tough cyclical demand trough, specifically hitting the EV and industrial markets. This forced everyone to make some really tough calls. To see what that looked like, let's walk through onsemi's financials. Back in 2023, things were flying high. Revenue was up at $8.25 billion, pulling in a very healthy net income of $2.18 billion. But then those headwinds hit. By 2024, revenue dropped to $7.08 billion. And then in 2025, it fell further to a tidy $5.99 billion. Net income shrank dramatically down to $121 million, largely because of restructuring charges, basically the cost of actively writing down and realigning their manufacturing footprint. It looks painful, sure, but this baseline is actually the launchpad for our whole story.
Moving on to Section 2, onsemi versus the competition, David versus Goliath.
You really can't evaluate financial performance in a vacuum. To see if onsemi actually navigated this storm well, we need to set the stage for a direct financial clash right in the deepest part of that trough, Q2 2025. Now, what's really interesting about this slide is the sheer contrast. On one hand, onsemi's revenue was at $1.47 billion, but by strictly managing what they produced, they maintained a really impressive 37.6% margin and delivered over $221 million in non-GAAP net income. STMicroelectronics, on the other hand, went the other route. They chased scale. They brought in a massive $2.77 billion in revenue, but the heavy weight of their massive operations and their own restructuring efforts turned all that top-line revenue into a GAAP net loss of $97 million.
The dynamic here is just so incredibly clear. STMicroelectronics is the undeniable Goliath in terms of sheer sales volume, but when you're navigating a market storm, bigger definitely does not always mean better. While ST was taking a net loss, onsemi's strict, unyielding focus on cost control protected their profit margins, allowing them to stay highly profitable on a much smaller revenue base. They weren't just surviving, they were actively executing a deliberate, highly focused plan to outmaneuver their larger rivals through pure operational discipline rather than sheer size.
Let's hit Section 3, the fab-right strategy. Short-term pain, long-term gain.
So how exactly did they protect those margins? Well, we need to completely reframe that 2025 revenue contraction. It wasn't a failure or an accident. It was a super smart, highly calculated pruning phase. They called it their fab-right strategy, and it is built on absolute ruthless efficiency. Instead of trying to be everything to everyone, onsemi actively divested from their lower margin business lines. They basically cut out the distractions. They shifted their focus heavily toward intelligent power and sensing, essentially the chips that act as the brains and nervous system for managing electricity. They standardized supply assurance for key customers and zeroed in on a target of 38 to 45% non-GAAP gross margins. By focusing exclusively on high ROI programs, they created incredibly reliable, predictable resource stability.
And this brilliantly illustrates what that focus looks like out there on the factory floor. This is a 200mm EliteSiC or silicon carbide wafer. By vertically integrating and controlling their own supply chain, from the raw materials right up to the packaged power modules, onsemi completely controls its own destiny. This standardizes their cost scaling, improves their yields so there are way fewer defective chips, and massively reduces the risk of schedule slips when they launch new power programs.
And all of that, the fab-right strategy, the silicon carbide integration, it all serves one sweet, massive end-user goal:
Electrification. These elite SiC products are the absolute secret sauce that provides the efficient power needed for 900-volt high-voltage electric vehicle architectures. This is the exact tech that gives modern EVs longer range and those super fast charging speeds. By pruning away the low-margin clutter earlier on, onsemi freed up the resources to deepen their partnerships with major automakers like Geely and NIO, putting themselves right at the center of the EV revolution.
Section 4, Q1 2026, a swift recovery, the turning point.
Okay, let's transition out of those tough decisions of 2025 and jump with high energy right into 2026. This is where those calculated sacrifices finally blossom into a beautiful, undeniable financial recovery. In the very first quarter of 2026, onsemi reported revenue of $1.513 billion. That actually beat the midpoint of their prior guidance. It was the definitive signal that market demand was strengthening and they had successfully emerged from the industry trough. Plus, both their standard and adjusted gross margins hit 38.5%, landing perfectly inside that target range they set during their Fab Right transition.
But they didn't just beat revenue expectations. So the crucial point is they unveiled a massive $6 billion share repurchase authorization. Just think about that for a second. During a recovery phase, they generated so much free cash flow they were able to buy back $346 million worth of shares in just Q1 alone. That was roughly 160% of their free cash flow for that quarter. It acts as a bold puzzle piece that completely solves the mystery of their underlying cash flow health. Listen to this quote from Thad Trent, their CFO. He stated, "Doubling our share repurchase authorization demonstrates our commitment to disciplined capital management and creating long-term shareholder value." That right there, that is the sound of an executive team with fierce, undeniable confidence in their ultra-strong balance sheet. They are generating consistent cash to return capital to shareholders while still investing strategically in future growth.
Which brings us to Section 5, Powering the Future, AI in Data Centers.
Let's move to and see how this builds into their incredibly sparkling future outlook. The low-hanging fruit has been pruned, the balance sheet is rock solid. So where is the explosive demand coming from? AI data centers. In this sector, onsemi's revenue didn't just grow, it doubled year over year. And perhaps even more impressively, it accelerated rapidly by over 30% quarter over quarter in Q1 2026 alone. With AI data center electricity demand expected to quadruple by 2030, facilities are absolutely desperate for highly efficient distributed energy architectures. Because onsemi held on to their R&D investments during the downturn, their power efficiency tech is perfectly positioned to catch this tidal wave of infrastructure spending.
Their CEO Hassani El-Khoury really summed up this strategic pivot perfectly. He noted, "As we continue to execute with discipline, we are investing in differentiated technologies across power and sensing that will define the next generation of intelligent, energy-efficient systems." It proves that the operational pain and pruning of 2025 was the exact catalyst needed for onsemi right now. They aren't just a supplier anymore. They are an indispensable systems-level partner capturing massive growth in AI and industrial automation.
So I want to leave you with this final provocative thought to chew on. As AI data centers and next-generation EVs drive absolutely unprecedented power demands globally, can onsemi's ruthless margin discipline continue to outpace the sheer scale of their much larger competitors? They've certainly proven so far that being the biggest isn't always as valuable as being the most focused. Keep a close eye on how this intense semiconductor rivalry unfolds over the next few quarters. Thanks so much for joining me on this explainer, and keep learning.